a little bit of a additional follow-up here after yesterday's USDA report. We kind of touched on that, but what we wanted to do is just put some target areas for support and resistance here on the charts as we go through, the major grain groups in here. So keep in mind, as we always discuss, everything is for education and example purposes. Make sure you guys understand and know your own risk tolerance as we go through the information. And one quick comment too, we're in the process of revamping our studio, if you will. So hopefully this little the sheet picture, as much as we like it, it's kind of an awkward spot. So hopefully we can get that updated. But let's go over to this daily May 25 corn chart in here. Really the biggest thing for us, obviously, this is your old crop corn. We had this strong move down and a little bit of a weak run up. I don't have volume on this chart, but the volume has been pretty low on this move up, which kind of indicates to us it's more of short covering rather than buyers stepping in to drive this market higher. So we have that white box below. We wouldn't be surprised to see this corn contract kind of come back into that area, which could also help add some carry into this market between old crop and new. As we go over to new crop, these are our two zones. And like we said, this stuff is rather boring, but this is the market in the hand that we're dealt for the time being. So when we go to D's 25 corn, we were calling support somewhere between 430 and 450. We just wouldn't be overly bearish in there. At this time of year, we still have a good chunk of South America's growing season to go through. And then we obviously still have U.S. planting and the growing season ahead of us as well. On the flip side, if we see a run up again, somewhere from 470 to 490, maybe even to 5, that's our targeted sell zone for now. We want to be rewarding rallies into there and setting our hedges, whether it's with cash sales, options, whatever you're comfortable with. That's kind of our area of action for the environment that we're in currently. As we go over to new crop beans, again, a little bit tighter windows in here. We haven't been very bullish on beans. The one thing we will point out, though, is with that USDA report here, we could be slightly less bearish. So we did have that low down in here to 960, and I believe front month low is somewhere around 940. That's still probably a fair downside target if we want to spike a little bit lower, but we wouldn't be overly bearish at that level either. This contract needs to kind of hold together to hopefully encourage some acres and kind of keep that supply and demand sheet balanced. We do have healthy exports, which is why we think we kind of have a lid on this market. When you move between 10, 50, and 11, that's where we would be looking to make some sales. But at the same time, in the current environment, we kind of question how much lower we really need to go. Like I said, is 940 a possible downside target? Yes. Do we really need to move below there? In the current environment for what we have now, I'd be a little bit hesitant at this point to say we really need to make a strong move below 940. Here's your Chicago wheat chart. We're looking at the July daily contract. Again, continue to hold in the support. This is a market we were a little bit more favorable and bullish on, but after that USDA report, we saw some ending stock numbers increase, so we are a little bit less bullish here. Nonetheless, when we go to the 6 to 650 area, that's where we want to be targeting for sales. Same thing here on the KC wheat chart. Again, really anywhere from 6 to 650 is our targeted sell zone for potential rallies. And then as we go to September spring wheat, really that 650 to 680, 670 zone is kind of what we're focusing on. So it's really a couple things that we just want to kind of clean up in here. If you're still holding on to old crop, especially corn, you really might want to consider switching over to paper. The things that we're asking ourselves here is how much revenue is sitting in your bin, how much cash flow. Okay, we don't have a problem with you being long the market or having a long bias. We think that's fine. But from a business perspective, a cash flow perspective, and even a risk management perspective, buying corn calls probably makes a lot more sense. Again, you can sell your cash corn, bring in some good revenue and cash flow, and then own back this crop on paper for a fixed risk position at a fraction of the cost. Now, whether the corn market goes higher or lower from here, again, that kind of goes back to your own bias. If you're holding physical bushels, obviously you're probably leaning bullish, and that's fine. We just think that there's a better way to do it that puts you in a less vulnerable position, that if this market does correct hard, you're not sitting there stuck trying to figure out where to make sales. At this point, if you switch to calls, your floor price is essentially set for you. As we look at new crop contracts, we like having target orders above the market. Like we said, to us this year, right now, it feels like we're just going to kind of bounce between these broad ranges where we don't want to be overly bearish when we get down to the lower end of the range. We don't want to be overly bullish and as we move higher. So have some target orders working above the market in those box areas with sales numbers you're potential with. Maybe you want to do 5 or 10% increments. Keep in mind, a lot of times you'll get hit on overnight volatility, and then the market will come back in on the day session. So that's why we like having those orders above the market. It's also going to help you follow through with that marketing plan. If your target orders pencil a profit for you, that's a good problem to have. You need to follow through with those sales. And if they get hit, that's a good problem to have. Obviously, we're not saying anything completely new here, but really the major catalyst to break the market out of the range is probably going to be weather and crop failures or some sort of war. Again, all of that we really don't know ahead of time, right? So that's why we want to have these areas in mind to continue to make sales and hedge our new crop contracts, and then figure out how much risk you want to have for those other outside unpredictable events, if you will. Again, some of that information will change. We can look at weather, for example, as we get further along into the year. So you'll want to adjust, how aggressive you want to be for sales. But nonetheless, as it sits today, we like rewarding the markets up at these higher levels in these ranges that we outlined here for you today. Keep in mind, for us, our goal is to always sell when we want to, not when we have to. So for us, that means just taking advantage when there's strength in the market, to be looking at making some sales decisions, even if it's just little 5 or 10% incremental sales. That's a good thing to do to just kind of keep things moving as we go through. If you guys have any questions, feel free to reach out to us. As always, we appreciate you tuning in. Make sure you hit the like button, subscribe, and thanks for watching.